Is the housing market going to crash in 2022? I mean, it's on everyone's mind. I mean, interest rates are on the move, inflation's on the move, something's gotta happen, right? But what? Well, I'm gonna answer that question for you right now. You ready? Let's go. Inflation is expected to continue. Mortgage rates are expected to increase. Could these be what finally shifts the real estate market into a downward direction? Maybe even a crash? How will these things impact the housing market? Well, we're gonna answer those questions. And by the way, if you're still looking to get that first deal under your belt, I put together a free training just for you to help you get that first deal done. And then how to earn $5,000 a month flipping contracts and properties working in as little as 1 hour a day. And you can access it at mattsfreetraining.com. Now, as you may know, home prices rose by nearly 20% in 2021. An astonishing rate of growth that was faster and more intense than even the run-up to the housing crash of 2008. And that one sunk the entire global economy. In recent times, you can find volumes written about the lumber shortage, the supply chain disruption, the remote work office exodus, and the record low mortgage rates that turned the 2021 housing market into one giant bidding war. But will it finally all come crashing down in 2022? If the pessimist inside you wants to believe that 2022 will bring an implosion to rival anything the Great Recession doled out, you won't have to look far to find a doom and gloom housing market analysis that confirms your worst suspicions. They're everywhere. The reality, however, it will probably be much less dramatic. Now, there are forces in play that could ease prices down, but gently. And they are two conflicting storylines that are teaming up to make a sudden crash unlikely in 2022. The first is rising mortgage rates. COVID-19 brought historically low interest rates that made it cheaper to borrow money than it had ever been before. Buyers across the country knew that such a chance would likely never come again, and they all raced to lock in their loans. Those record low rates, however, have already started to inch up and continue to climb. In fact, the Fed is essentially guaranteed that they will. With the cheap money incentive drying up, demand, and therefore prices, should plummet, bringing to fruition the crash that so many fire and brimstone pundits have predicted for 2022. Well, first, and to be clear, interest rates do not directly correlate with home prices, nor vice versa. However, low rates do tend to stoke homebuyer demand, and it's the higher demand that leads to higher sales prices. While rates and home prices have not completely mirrored each other over the past 5 years, home values did start their meteoric rise when interest rates cratered in 2020. A similar inverse pattern could unfold this year, with mortgage rates expected to experience a number of hikes by the Fed. Having said that, the lack of inventory could still support housing prices. I personally don't anticipate interest rates to impact housing prices much, if at all. In fact, due to demand in the market right now and the pent-up demand sitting on the sidelines since the beginning of the pandemic, prices will likely increase, but just probably not at the exponential rate that they did last year. If the housing prices were to crash, it would have more to do with a lack of demand, of which at the moment, the only thing that I can see that could impact that are the mortgage rates. The second thing, the supply. You see, there's not enough supply for the existing demand to cause a crash. Although home builder confidence is at an adequate level to steadily add new homes to the market, homes aren't being built anywhere near a pace that would flood the market with excess supply. When supply and demand come into line with one another, we will see a normalization of the market. But based on the latest numbers from the National Association of Realtors, we're about 10 years away of supply catching up to demand. At best. In the short term, as buyers look to find a property before higher rates impact them, we will likely see home prices firmly push higher. So, where does affordability go from here? I mean, how can people afford these homes if the prices are going to continue to rise? Well, as interest rates rise, as you likely know, affordability tends to decline because house hunters have less buying power. That's pretty much common knowledge. Higher rates can equate to higher prices, albeit indirectly. But there is something that's not so commonly known about interest rates and their impact on home prices. And if you want to know what that is, let me know by smashing the like button. And if you'd like to stay in touch with valuable real estate info each and every week, click the subscribe button too, because that's what I do here each and every week. Now, what most people don't realize about housing prices is affordability is relative and goes beyond just listing prices and mortgage rates. Affordability is continually a comparison of renting versus buying. Further, buying real estate comes with an additional advantage of a fixed rate mortgage, of which will quickly come to be your best wealth building friend in the face of higher inflation. You see, as inflation is going to impact the appreciation of your property, it also impacts wages and salaries. And when you have a fixed payment and your salary increases, that house becomes more and more affordable as time goes on. And then there are the tax advantages of owning real estate, as it's the last real tax shelter available for the average person. And overall, owning real estate continues to be the best savings vehicle and wealth creator for the average person too. In 2019, homeowners in the United States had a median net worth of $255,000, while renters had a net worth of just $6,300. That's a difference of 40 times between the two. That alone is justification to FOMO your way into buying real estate regardless of price. But it's understandable that you want a good deal too. You know, many people are waiting for a crash, and I don't blame them. With such rapid and sustained price increases throughout 2021, people are wondering and actually anticipating another bursting housing bubble on the horizon. I mean, there's gotta be, right? I mean, prices have been rising for way too long now, at almost double the length of the typical housing cycle. Because we all know what goes up must come down. Isn't that what people think? I get it. But parallels drawn to the 2008 mortgage crisis aren't accurate, since underwriting standards tightened significantly since then. You know, in the last 15 years or so, banks have written the best books of business, filled with A-grade paper. It's the best book of business that they've ever written. Homeowners aren't going to suddenly just start defaulting due to grossly adjusting mortgages. That environment, it doesn't exist today. The pace of home price growth will likely slow this year, but any kind of market crash scenario seems very unlikely and shouldn't be counted on. Because of this, acting as soon as possible in your home buying or refinancing journey probably is the best way to spend less money. With the Fed's projected rate hikes, the window for buying that next investment property or dream home, it can close quickly, especially when it comes to the middle and lower end of the socioeconomic paradigm. It's there we will see the biggest impact and inverse reaction to increasing interest rates and home prices. It will have little to no impact on those within the higher end of the market. But let's say I'm off here and interest rates rise more than expected and homes get built faster than expected. We're still unlikely to see a crash due to strong wage inflation. First-time homebuyers or buyers looking to upgrade would likely be eager to, and very quickly to, step into the market should prices start to drop, which would save the market from any sort of crash. If saving money on your next purchase, if that's on your mind, it's likely to make more sense to take action now rather than wait. You'll want to buy while rates are low, rather than deliberating over the uncertainty in home prices. Given that the market is being driven by true supply and demand, as opposed to the artificial demand caused by easy credit pre-2007, I do not see the market price of homes decreasing anytime soon. If anything, they will continue to increase, with maybe some minor corrections in some isolated markets. If you'd like some help picking up your next income property, I've got some free information for you to help with the purchase, the rehab, the financing, and management of that property. Download a free real estate investor package at cashflowsavvy.com. And if you would like to take it a step further, you'll have the opportunity to pick a time to hop on the phone and just brainstorm some ideas around what it would all look like for you. That's it for today. Thanks for watching. I'll see you next time.